Good afternoon, everyone. It's my privilege to welcome you back to the Peterson Institute for International Economics for day one of our fall program. I'm Adam Posen, president of the Institute, and we're delighted to have with us a number of old friends and country experts, as well as market economists and officials today in person, but also, of course, on the web where we're webcasting live and where this will be available on podcast. Today's event is really about going underneath the news in Brazil. As many of you know, as I assume all of you know, things are not going too well for the Brazilian economy at the moment, even by standards of Brazil's past and even by standards of EM right now. We have been doing various strands of work that we think elucidate some of the underlying factors behind Mexico's poor performance at the moment. And so while, of course, there is an important straight-up macro story, capital flow story, and we'll be happy to discuss that in the program, our main emphasis today is on some of the longer-term drivers and structural decisions, or rather non-decisions, that the current Brazilian government has made, and most importantly, their economic effects. I'm very pleased to be introducing today our newest senior fellow, our non-resident senior fellow, Dr. Monica DeBola. She joined us initially as a visiting fellow earlier this year, and we're publishing today her insightful new Institute policy brief, Do Public Development Banks Hurt Growth? Evidence from Brazil. It's tightly argued. It will upset some people. It has good, solid empirical work that went through our refereeing process, and all the data is available on the website. And I think it's very important work, even as someone who, throughout the financial crisis, was advocating greater action by central banks to create funding in a recession. It would be churlish and silly of me to not recognize the distortions that many times public lending institutions induce in the economy. And it is very clear from Monica's work, as well as others, that BNDES and some of its other institutions in Brazil have been at the extreme end of that. And I think this is a very important part of the story. Monica remains a professor of macroeconomics at Pontifical Catholic University of Rio de Janeiro, and she's managing partner of Galanto MBB Consultants, which is a macroeconomic advisory firm. Previously, she was director of a think tank economics specialized think tank in Brazil, the Institute for Economic Policy Research, Casa de Garras. Did I get that anywhere close to right? Sorry. And like so many of our friends and colleagues, began her career as an economist at the International Monetary Fund. Monica will come up first to present, and then we're going to turn to a friend of the Institute, Dr. Alberto Ramos. Alberto is co-head of Latin American Economic Research in the Global Investment Research Division at Goldman Sachs. More importantly, in some ways, he is widely recognized as a very thoughtful, balanced, and rigorous thinker about Latin American economic developments. He joined Goldman Sachs already as a vice president in 2003, was named managing director in 2009. He also had been at the IMF for 6 years prior to that and worked on Argentina, Brazil, and Turkey in dealing with debt sustainability issues. So it's very well qualified and going to give us some more of the macro background today, and we're grateful to Alberto for taking the time to join us to give us that outside perspective. And then finally speaking today is going to be Jeffrey Schott, who of course has been a senior fellow at the Institute since 1983, but doesn't look a day older than he did then, of course. Jeff is at the core of much of what we do. Our multi-author and ambitious projects on TPP that will be coming to fruition if the talks ever come to fruition are being led by Jeff with Kathleen Chimino-Isaacs. Jeff, of course, was in many ways the uncle and father of Chorus, having led our work on free trade agreements and helped write his study in free trade between Korea and the United States in 2001, which laid the groundwork for Chorus, and has been a member of the Trade and Environmental Policy Advisory Committee of the U.S. government. He's also a member of the State Department's Advisory Committee on International Economic Policy and chairs its Sanctions Committee. And of course, has co-authored with Gary Huffbauer and other fellows here a large number of studies through the years. Jeff is going to be talking about some work we did with Barbara Kochwar and others here at the Institute related to the efforts, frankly, of the U.S.-Brazil Business Council, that Brazil, in any sort of geographic baseline or economic baseline, is under-globalized. It is under-globalized, and under-globalized specifically in terms of its integration with its neighbors to the north in the U.S. And that, along with Monica's emphasis on the financial side, I think provides an important structural analysis to underlie Brazil's current problems. I will allow the three speakers to come up here, and then we will assemble as a panel and take questions and comments from this high-level audience, and we're grateful to you all for joining us. But I will just take a moment to not only advertise Monica's coming, and there will be other new people we'll be excitedly introducing to you over the next couple months, but just to preview that we have many other events coming up in the next few weeks. We're fully into our fall programming. We will be holding, in addition to this, of course, some major events on the Chinese-U.S. Summit. We will be holding an event on multilateral development lending, the Asian Development Bank, the AIIB, and the Silk Road on September 30th. Our semi-annual Global Economic Prospects meeting, led by David Stockton, the former Fed chief forecaster, will take place on October 1st. Joining him on the stage will be Nick Lardy to remind us why Nick says China's fine, to oversimplify massively, but anyway. And our newest full-time senior fellow, Paulo Moro, who joined us a little less than a year ago on some of his deep work on fiscal policy and consumption. We will be holding as well a major conference in mid-October led by Joseph Gagnon on the spillovers of quantitative easing, bringing together a number of official and market assessments. And in mid-November, a conference on productivity growth, slowdown, and the implications for policy. So we have a lot of exciting things going on, as well as some specialized topics, including another one where Jeff will be appealing on Korea and TPP that we'll be doing later this month, and we look forward to keeping you all informed. End of advertisement, on to the substance. Monica, please take the stage.
Well, good afternoon, everyone. Thank you, Adam, for that very, very kind introduction. Let me start by saying that it is testament to how low the mood in Brazil currently is that my kids yesterday did not want to watch the 4-1 win, the match between Brazil and the U.S. They rather wanted to watch the Williams' sisters match at the U.S. Open. So this, I think, kind of sets the tone of where we are in terms of, sentiment in the country. So let me start with this chart. This is something that is fairly, well, at least to some people, fairly well known. Brazil is a country that hasn't been growing very, very much for a while. This chart tries to look at what's happened to Brazilian GDP per capita relative to US GDP. So in a sense, it's a chart that aims to capture some kind of catch-up between Brazil and the US. And it shows here only two phases, one here in the late 1960s and early 1970s, and the other one here during the commodity boom, where there was a significant, let's call it, catch-up of Brazilian per capita GDP relative to US GDP within, a very large time period. We're talking half a century. The fact that the Brazilian economy hasn't been doing well for quite a long time has been attributed to a number of reasons. So people have cited the fact that the economy is very closed, that taxes are very high and very complex in Brazil, infrastructure, there are numerous problems in infrastructure in Brazil, business environment is not that great, labor laws tend to be very rigid, but other emerging markets face similar types of problems. And yet there are things in Brazil that make it stand apart. And one of these things that I think has been largely overlooked in the literature is the role of public banks, and to what extent public banks actually generate certain types of distortions in the economy that end up hurting growth. So that's the main point I want to make here. So by the end of this presentation, what I hope to convince you is that public bank lending in Brazil, at least over the last few years, has been one of the causes for very high real interest rates in Brazil. And having very high real interest rates basically means that you have very high costs for capital. This hurts investment, this hurts productivity, this hurts growth. So this is the gist of the argument and the reason for the focus on public banks specifically. This is a chart that is pretty much well known, or at least a fact that is probably very well known by all of you. Brazil has the highest real interest rates in Latin America. So here, real interest rates are here, the red bar. Next to it, we have Argentina and Ecuador. Ecuador has its own financial sector issues and problems with evaluating credit risk and a host of other factors. Argentina, well, as a Brazilian, I'll just say Argentina is Argentina, and it has its own peculiarities. But Brazil really stands out and has been a country that stands out with respect to real interest rates for quite some time, even if the recent trajectory had actually been pretty good. The country was able to bring down interest rates, real interest rates for, this covers 2004 to 2014. So over this period of 10 years, real interest rates did come down quite substantially, although they remain very high. I'm going to come back to this chart at the end of the presentation. So what's the issue? So the issue with public banks is not just that they lend a lot and that they have been lending a lot, but it's specifically that they have been lending a lot at subsidized rates. So if you take the activities of the three main public banks in Brazil, and this is BNDES, the Public Development Bank, the mortgage lender, Caixa Econômica Federal, and Banco do Brasil, which is a commercial bank, but it used to be Brazil's central bank before the central bank was created in the 1960s. These three institutions represent today about 55% of the credit market, of the bank lending market in Brazil. And these three institutions, the way that they operate, the Banco do Brasil is a bit different, but the mortgage lender and BNDES both lend at subsidized rates. All of their lending lines are subsidized in one way or another. So what this means is that at the end of the day, you have a large portion of the credit market that is actually non-responsive to policy rates practiced by the central bank. So a large part of the credit market is not responsive to monetary policy. And this is just one of the problems, and I'll come back to that problem in a moment. BNDES, of this 55% of the credit market, BNDES accounts for about half of this 55%. As I said before, all of its lending lines are subsidized. There's an arrow here that shows what's happened to BNDES lending as a share of bank lending. It's obviously expanded quite a bit during the financial crisis. This was a very useful counter-cyclical instrument to use during the crisis. The problem is that what was done with BNDES in terms of credit expansion was never scaled back after the crisis. So it continued to expand credit at a very rapid pace, again, doing it in subsidized terms. Now, what this large amount of subsidized credit does in the system is to create credit segmentation. So you have a certain portion of the market that is actually being set by non-market rates, which is the red line down here, and you have another portion of the market that is responding to market rates, and you have this wedge between the red line and the blue line. This wedge, and the fact that it is so large, suggests that the subsidized activities of public banks, and of BNDES in particular, generate a kind of adverse selection problem. So to the extent that you're lending in subsidized terms and you're capturing the better borrowers in the system, you're leaving the riskier borrowers for the private institutions, meaning that these institutions really have to charge higher risk premia and thus higher interest rates. So you create this kind of microeconomic distortion as well in the system. So how is BNDES doing this? Where's the evidence that BNDES is doing this? Well, BNDES lends, and there's an argument here where, if firms are large, it doesn't necessarily mean that they're credit constrained. You can have a large firm and that firm be credit constrained. This is a point that I'm very grateful to our colleague Caroline Freund for making when we were discussing the confection of this paper, of this policy brief. But in Brazil in particular, the companies that BNDES is lending to are companies like Petrobras, Vale. In other words, companies that you would be hard-pressed to argue that they do not have market access of some sort. And you would be hard-pressed to argue that they're not good borrowers. Let me make an aside and say that for now, Petrobras may not be in that camp, so we won't talk about that. But you would be hard-pressed to argue that these companies are not cash-constrained or credit-constrained, and hence this kind of adverse selection issue that BNDES creates is very much present, and it is very much one of the reasons why banking spreads in Brazil are as large as they are, and the segmentation problem as serious as it appears to be. So essentially what happens when you have these vast amounts of subsidized lending to companies being done in a way that in some instances lack the proper transparency and checks and balances and things of that sort, is that it makes you fall into a kind of a trap. And here's a very stylized description of that trap. So you have a bank like BNDES that is trying to resolve a market failure. And the market failure that it's trying to resolve is lack of long-term credit markets. Brazil still has that problem. It doesn't have long-term credit markets. So BNDES steps in with a lot of subsidized lending. Now, in order for it to grow its balance sheet the way it's been growing its balance sheet in recent years, it has needed to resort to Treasury in order to finance its loan. So it's getting its funding from the Treasury. The Treasury, in turn, is lending to BNDES at subsidized rates, but it's borrowing from the market at market rates. So when it does this, it's issuing debt in the market and is, of course, putting upward pressure on interest rates when it does this. So you already have a channel here whereby BNDES puts pressure on interest rates. On the other hand, Treasury lending to BNDES in the period 2010 to 2015 has been of the order of 10% of Brazil's GDP, which is a lot, and adds to public sector debt. So gross debt numbers in Brazil reflect this amount of Treasury lending to BNDES. On the other hand, the fact that Treasury is lending at subsidized rates to BNDES and borrowing at market rates creates an implicit subsidy. That subsidy, because of the amounts that we're talking about, is roughly of the order of 0.5% of GDP annually. So, coming down to the third box here, the implicit subsidy that you get from this kind of operation between BNDES and Treasury creates a number of budget pressures and, of course, budget execution issues, which, of course, then feed back into higher interest rates. Higher interest rates, in turn, feed back into budget execution issues to the extent that the interest bill keeps rising over time. And then, of course, you have this whole cycle of how the interaction between BNDES, Treasury, lending by BNDES, and so forth works through the fiscal to raise interest rates. On the other hand, you have the monetary policy issue, which I mentioned earlier. So BNDES is expanding credit while the central bank is trying to maintain price stability. These two objectives work against each other. At the same time, BNDES is lending at subsidized rates, so it is making part of the credit markets unresponsive to interest rates. So in the end, the central bank has to raise interest rates by much more in order to keep prices in check than it would otherwise have to do if BNDES were not acting in this way. So again, you get another channel of pressure here for the rise in interest rates. In the end, you get this much larger increase in interest rates, which hurts growth, hurts productivity, and ends up undoing the objective that you were setting yourself up for. So BNDES was trying to resolve a market failure. And in the end, it ends up raising interest rates to an extent that that market failure persists. So that's the kind of trap in sum that sets up BNDES alongside fiscal policy and monetary policy. So what's the evidence? So I ran a few regressions with real interest rates here as a dependent variable and a bunch of other explanatory variables. And the interesting thing that comes up, of course, is that the coefficient on BNDES lending as a share of GDP is highly significant and positive, meaning that, yes, when BNDES increases its level of lending relative to GDP, there is upward pressure on real interest rates. Taking this one step further, and this covers a period, the 10-year period 2004 to 2014. Taking this one step further and looking at to what extent this actually hurts productivity growth through these various channels, the real interest rate channel and so on, I then ran some regressions with total factor productivity as a dependent variable here, a number of explanatory variables on this side, BNDES and real interest rates are here. Both of them, and we can see that they're both direct and indirect effects that we can measure. So BNDES lending as a share of GDP, when we exclude real interest rates from the equations, we have a negative and significant effect, meaning that BNDES lending, increases in BNDES lending affect negatively productivity growth. And the indirect channel is whereby BNDES affects real interest rates, and hence real interest rates in principle should affect total factor productivity growth, and they do that negatively also. So you also have that channel going through real interest rates. So with this in mind, the obvious thing that one would think is that this cycle, this kind of trap that I described, needs to be broken somehow. And there are many things that the current government is proposing, or at least started proposing. There are many things that the current finance minister, Mr. Joaquin Levy, was actually proposing to do. Some of these things involved scaling down and streamlining BNDES, in particular going into its subsidized lending operations and significantly reducing those. From these calculations that I just showed you, there, you can do a simple calculation to see that if BNDES disbursements actually fell to, say, their 2004 levels or something like that, prior to the period when they were increasing massively, real interest rates could actually fall by as much as 1.3 percentage points, which is a lot. So one thing is to rethink the role of BNDES along these lines. Another thing that needs to be done is to eliminate the subsidized component, because this is really very distortionary in the markets. And you could do that in various ways. It's a bit beyond the scope of this talk to do how exactly technically you would go about this. But one would think that if you gradually link these lending rates that BNDES concedes to market rates, over time, you should get rid of this problem. So that's another way to think about how to move forward with BNDES. The objective, obviously, at the end of the day, is to end the kind of perverse crowding out effects that you generate and that end up hampering the development of capital markets, as I was saying initially. So what you want to do, basically, is end credit market segmentation and these kinds of perverse effects that I just described. What does the past experience show us? And this is where I'm going back to the very first chart where I had the evolution of real interest rates between 2004 and 2014. So if you break down that period, that 10-year period in three separate periods, so you have one here running from January 2004 to the eve of the financial crisis, then one that basically covers here the years of the financial crisis and the post-financial crisis years, and then the more current period from January 13 onwards. There are three very distinct periods here and how they relate, and it's interesting how they relate to what was happening to real interest rates during that time. So in this first period here, what we had a bout of inflation that required very high levels of nominal interest rates, but after that, real interest rates actually fell consistently. At that time, the government was running an average primary surplus of 2.5% of GDP, and public sector credit had actually dropped from 50% of total credit to 35% of total credit. So presumably, these two things combined had a big effect in allowing this to happen, this fall in real interest rates. Between this period here, which was a very complicated period, as we know, right after the financial crisis, well, there were a number of counter-cyclical measures being put in place, both on the credit side as well as on the fiscal policy side. So obviously, the primary surplus fell. Public credit began to rise, but real interest rates were still arguably on a downward trend. The problem is this last period here, where public credit has now risen to levels above their pre-2003, early 2000s levels. So we're now, as I was saying in the beginning, back at the 55% market share in public sector credit, while at the same time, the average primary surplus within this period, and this is, again, taking the period between 2013 and 2014. 2014 in itself was actually a very bad fiscal year for Brazil, but the average primary surplus in that period was 1.1% of GDP. So this kind of breakdown gives you an idea of what could actually be achieved if you were implementing the right policies. We did that in the past, and the idea is how do you then replicate them now, and what you would get from replicating them now. This is this combination actually of fiscal consolidation and retrenchment in public lending was the way that Minister Levy had actually portrayed the economic agenda for Brazil going forward when he was first announced as minister. The problem is that since then, things have changed various times, and they have changed more recently again. So now what we have is a recently announced initiative by the Brazilian government to actually use not BNDES, because BNDES is currently under scrutiny by Congress on its previous operations, but the public mortgage lender to lend to ailing sectors in the economy. Now, this is a public mortgage lender. It's a bank that in principle has no expertise in lending to things like, say, the chemicals industry or the automotive industry. And yet, this is what the Brazilian government is deploying this bank to do. Obviously, this is likely to create significant contingent liabilities down the road. And it's going against the principle of retrenching public credit and retrenching subsidized public credit in particular. The second issue is the fiscal consolidation issue. So whereas first there was a very clear fiscal path that was set for Brazil with targets set for ambitious targets set for 2015 and 2016 of the order of 1% and 2% of GDP, these targets were lowered to 0.2% of GDP for this year and 0.7% of GDP for next year. These are primary surplus targets. And now, just recently, over the last few days, the government has sent a budget proposal to Congress that envisages for next year a primary deficit of 0.5% of GDP, or in other words, 1.2 percentage points lower than the target that was announced before. So clearly, we're not in the path of fiscal consolidation plus retrenchment in public lending that would be needed to resolve this very high real interest rate, very high cost of capital situation, which is what really would help us out of this serious growth trap that we find ourselves in. So the bottom line, just to end here, is that for the moment, there doesn't seem to be any constructive agenda to resolve the crisis. Thank you.
Thank you very much, Monica. Just to emphasize one thing she said, which I hope you will take away, 1.3% on real interest rates is a huge number. If her analysis is anywhere close to right, I believe it is, as an ongoing structural sign of the degree of distortion in Brazilian markets and the impact of potential reform, that is enormous. Anyway, but understandably, Finance Minister Levy and Governor Tombini have to worry about some short-term issues as well, and the context in the global economy. And for that, we turn to Alberto Ramos, if you'd be willing to take the stage.
Well, good afternoon to all. It's a great pleasure to be here in Washington. Many thanks to Adam and to the Peters Institute for the kind invitation. I think Monica made a great contribution to understanding the costs of well-intentioned policies and the hyperactivism of public lending in Brazil. Certainly through market segmentation, you end up with very high interest rates, undermines the effectiveness of monetary policy in maintaining the nominal anchor of the economy, so you end up in a very surreal picture of very high inflation and very high interest rates at the same time. I don't want to spend a lot of time here focusing on what happened, what brought us to the place where we are today. I want to discuss a lot more what needs to be done to get out, of the current picture. But in order to do that, I think it's important to understand what led us, to the place where we are today. And if you were to get, Monica and Marcelo and 3 or 4 other well-trained economists in the room trying to discuss what Brazil needs to do, I can tell you that that discussion will not last more than 5 minutes. What Brazil needs to do, it's quite simple in terms of the assessment, in terms of the diagnostic. It's not simple or easy from a political standpoint, from a social standpoint, because what we're talking about here is macroeconomic adjustment. What is happening in Brazil today is altogether not surprising at all. That's what comes after a populist experiment. And populism, you can define it by creating an artificial sense of prosperity, of empowerment, of enfranchisement through mechanisms that are unsustainable, that go beyond, the productivity frontier of the economy. They end up creating macroeconomic imbalances and distortions. After populism comes adjustment. That's exactly the stage where we are today. But going back to what Brazil needs to do, it's a much, much simpler question than whether Greece should be part of the euro or not part of the euro, where Janet Yellen should hike in September, in December, or not in 2015 at all. What they need to do is basically undo everything that they have done over the last 4 years, in very simple terms. I think the footprints are still out there. They are still very visible. What happened, 5 main things. One was a significant erosion of the fiscal stance. Right? So we see there on the left side, the panel shows the primary fiscal surplus of the consolidated public sector. Not long ago, we talk about July 2011, not long ago, the primary surplus was more than 3.5% of GDP. It's now tracking at around -1. Basically, you blew up 5 percentage points of GDP against the backdrop of a rising tax burden. This is not a story about declining revenues that led to the underperformance of the fiscal. This is a story of spending activism and lending activism that had very obvious quasi-fiscal costs. The mirror image of that is the right chart that shows you the increase of net public debt. So the economy levered up without growing. And the picture that we see about, the increase in leverage of the public sector, there is a very similar picture that shows also the very significant increase of leverage of the household sector and also of the corporate sector. So that was, the thing that happened over the last 4 years, a significant destruction of the fiscal anchor that ended up also undermining the credibility of monetary policy. The second one was the weakening commitment to price stability, the weakening commitment of the central bank to maintain inflation at around the target. And I'm sure many of you know that the target in Brazil is 4.5 plus or minus 2. Is extraordinarily high. Nobody really targets inflation at 4.5. I'm not even discussing who came up with a half, but 4.5 plus or minus 2 means that inflation up to 6.5% is within the target. It's like, you said for yourself, I'm going to run a mile in 30 minutes plus or minus 10. It's not really a challenging target, like 4.5. 4.5 should be actually quite easy to get, but it's not. Inflation is tracking today at 9.6 and will remain above 9% until the end of the year. So over the last few years, there was this view that in order to protect growth, we need to lend and we need to keep real rates artificially low, so they softened the commitment to the inflation target. The third problem was that they used and abused the balance sheet of the public banks in order to stimulate consumption, and they intervened too much in the economy, and the intervention had many angles associated with it through public tariffs. They repressed public tariffs as an indirect instrument to control inflation rather than using interest rates as the classical instrument, to tighten financial conditions. They also repressed the exchange rate as another indirect instrument in order to control inflation. That ended up, in the situation that we had an economy that is not growing, investment spending was declining, and guess what? The current account deficit was widening. For a country with no growth and declining investment, meaning that you run a current account deficit in excess of 4% of GDP, at steady state of 2.5% growth, the current account deficit would have been more than 6 percentage points of GDP. Cyclically adjusted, that current account imbalance was huge, given the backdrop of no growth and declining investment. As you know, the current account is by definition the savings minus investment balance. So what they need to do is precisely undo everything I just said, so renew the commitment, to the inflation targeting framework, rebuild fiscal credibility and the fiscal anchor, stop using the exchange rate in order to control inflation, let the currency float, at least come close to it, stop using the administered prices as indirect instruments to control inflation, and stop using and abusing the balance sheet of the public banks in order to stimulate credit. And we saw, all the consequences of that from the micro to the macro. So that's the agenda. It's pretty simple, again, very, very difficult. And the problems that Brazil faces today, it's a mixture of, short-term cyclical issues with more medium-term, long-standing structural issues that have been out there for 20 years and have not changed at the margin. Went through a period of a very significant rally in commodity prices that allowed, maybe, this model to run far long than what would have been the case if commodity prices and the global backdrop of very abundant, global liquidity was not what we saw over the last few years. So we need to rebuild fiscal credibility, renew the commitment to inflation targets, stop using the public banks, stop controlling the exchange rate, stop controlling public tariffs. The market has invested a lot in the personal credibility of the new Minister of Finance, Minister Levy. He's certainly a very talented, honest, publicly committed, experienced individual, capable of doing it. But guess what? He does not walk on water, right? He has to operate within a given political reality, with a given economic backdrop. It's always very, very difficult to do a fiscal adjustment against the backdrop of an economy that is contracting. On top of that, the most significant fiscal issue in Brazil is not a short-term issue. It's not the erosion of the fiscal stance because the cycle has turned around. It's of the rigidity in mandatory spending and entitlements that have a natural drift of 0.2, 0.3% of GDP per year, like because of the demographic profile and indexation rules and many other things. Mandatory spending, which probably 80 to 90% of the budget, is increasing every single year by 0.2, 0.3. So you cannot just continue to push the tax burden in order to cover those the deficits that are embedded in the baseline, because the tax burden in Brazil is already quite high. In the short term, they need to send a signal of credibility to the market, to the rating agencies. They need to find whatever they can find in order to turn around, that fiscal picture, soon enough to avoid the loss of investment grade. But over the medium term, they have to face, the structural issues that are in the budget and many other parts of the economy. If you look at some of the key issues that have perennially been handicapping Brazil, the performance of Brazil, it's a very, very closed economy to trade. And Jeff, will dwell more on that. I'm sure many of you know that actually Brazil is the closest economy to trade in the planet. Actually there is only one economy that trades less than Brazil, which is East Timor, and that should not necessarily be the right benchmark in order to assess, the performance of Brazil. But we need also, to increase, fiscal savings, and that's why, fiscal consolidation, it's so important. We're looking at this chart. It's the twin deficits, the twin current account and fiscal deficit. Again, not long ago, 7, 8 years ago, the twin deficits were around minus 2 percentage points of GDP. That's a combination of the fiscal deficit, overall fiscal deficit, not the primary surplus, and the current account, which prior to 2008 was actually generating a surplus. And we have seen a very, very steady deterioration. This is the worst point in that picture if you run maybe 30 years back. The twin deficits are now approaching 14% of GDP, with a fiscal deficit of around 9% of GDP, which would lead me to argue that the fiscal picture in Brazil is possibly worse than Greece. At least the interest bill is higher. The debt burden in Greece is higher, but the cost of carrying and servicing that debt is a lot lower. And you also need to turn around, a current account deficit in excess of 4% of GDP. One of the key variables to promote the adjustment is the exchange rate. As you can see from the bottom panel, this is a currency that has been significantly overvalued, for the last, 8 to 10 years. At certain points, the degree of overvaluation exceeded 50%, meaning that the Brazilian real was the most overvalued currency among the emerging markets we cover. The real has now corrected a fair amount. We put fair value, which is probably the gray line that you can barely see at the top panel. Above the green line is our estimate of fair value, which is spit out by a fair value model that takes into account all the things that determine the equilibrium real exchange rate. And we have seen that, the recent dislocation, very rapid dislocation of the currency has basically brought the currency close to fair value. But we have been arguing for a while, it's actually in one of the papers we just distributed, that fair value is not enough for Brazil. There is absolutely nothing that is fair in Brazil these days, so fair value is not fair. You need to go well beyond that. The currency needs to be slightly cheap to fair value. I'm not calling for an overshooting of the currency, but if you look at, the Dornbusch adjustment model with, where financial variables adjust much faster than the goods and services markets, the currency needs to overshoot in the short term, not a massive overshoot, of course, but we need to go well beyond fair value. If fair value for us, it's around 3.5, we think that an ideal value for the adjustment that Brazil needs to undergo would be between 3.8 to 4.0, which is a moderately cheap to fair value currency, would contribute to facilitate the adjustment, accelerate the adjustment, turn the adjustment more efficient. Once the adjustment is more mature, more advanced, the economy is more balanced, we see, signs of stability emerging and eventually some green shoots of growth, starting to emerge in parts of the economy, then yes, then the currency can initiate another cycle of appreciation. At the top of the cycle will be slightly overvalued again, but not now. I think, finally the authorities, are coming close to that view. The FX market activism has also, reduced quite significantly, even though this is still a highly intervened currency. The stock of dollar swaps issued by the central bank to control the currency are still in excess of 100 billion. The quasi-fiscal cost of that type of intervention has been gigantic. We're talking about 2% of GDP. For you to have an idea, 2% of GDP is 4 times larger than the conditional cash income transfer program of the federal budget, the Bolsa Familia, which consumes 0.5% of GDP, which is exactly the same number that Monica gave us about the cost of, the quasi-fiscal cost of lending from the BNDES. So we're still currency bears. We still feel that this currency needs to move more, most likely will move more. The market is trading on the bearish side of the currency. The central bank is still intervening way too much, very costly intervention. We're starting to see spot market outflows rather than hedging exposure. Right now what we have seen, what created that dislocation of the currency were not capital outflows from the economy, but was basically hedging of local exposure, hedge funds and oil companies and many other investors in the economy that bought dollars as a hedge to the exposure to their real investments or financial investments in the economy. But we're starting to see a mutation a little bit of the nature of those outflows, which is spot outflows, basically saying people are divesting and leaving the economy. I don't want to protect my investment. I want my money out of the country. And that is changing a little bit the nature of the game. I don't want to overextend myself, but this is the behavior of the exchange rate. And this is a very interesting table. I'm not going to go in detail over it, but I leave it to you as a reference, which kind of links the duration of the current account, which by definition is, again, the savings minus investment balance, to between the decomposition between the private sector and the public accounts. So we look at private investment and private savings and do the same decomposition for the public sector. And what we have seen is a 2 percentage point deterioration of the current account in 3 years, in an environment of close to zero growth and declining investment. So if investment is declining and you see that total investment declining by 1.8 percentage points of GDP, what led to the deterioration of the current account was the decline of domestic savings. So if you go to the decline of domestic savings, was not the private sector that was saving less. Actually, when you look at the contribution of the private sector to the current account, all else constant, ceteris paribus, the current account should have improved by 2 percentage points of GDP rather than having deteriorated by 2 percentage points of GDP. So we have to bring the public sector into the spotlight And the deterioration of the current account was not because the public sector was investing more, because they were not investing more, but is the brutal decline in public sector savings of almost 3.4 percentage points of GDP that drove the current account deficit. That's why it's fiscal, fiscal, fiscal. It's fiscal that is needed in order to reduce the perennial overvaluation of the currency. It's fiscal that is needed in order to help to disinflate the economy. It's the fiscal that is needed in order to help to correct the current account deficit. It's the fiscal that is needed in order to bring real rates, to much more, moderate levels. Just some final remarks before I give the stage to Jeff. What is the medium-term agenda of Brazil? It's an old agenda. It's not new. It's an agenda of reforms. I know that reforms is a buzzword. Everybody needs to reform. The US needs to reform. Japan needs to reform. Brazil also needs to reform. And what are the main issues? Very, very low level of domestic investment. If you invest 18% of GDP, you cannot hope, to sustain growth rates with price stability much higher than 2 to 2.5% of GDP. Not only is Brazil has a very, very low investment ratio of 18% of GDP, but the domestic savings are even lower than that, right? By investing 18% of GDP, you cannot only have a current account deficit of 4 if your domestic savings are only 14. The biggest saver in the economy is the public sector. It's not for lack of resources. The tax burden in Brazil is very, very high. It's higher than the average of the OECD. We're talking about a tax burden of 38% of GDP and going higher. The level of public spending is even higher than that because they are running a deficit. So they are spending more than 40% of GDP. And the level of public investment is less than 2% of GDP. So less than 5% of total federal spending is actually in investment spending. Total spending by the federal government is about $27 billion. At the actual exchange rate, is actually much, much smaller than that. But about, let's say, $25 billion. To build ground zero in Manhattan costs 17. Brazil is a country that, in terms of land mass, is bigger than the US. That gives you a little bit, the degree of underinvestment that you have in the economy. So you need to save more. You need to invest more. You have a tremendous deficit in physical infrastructure. You need to trade more. Brazil is extraordinarily close to trade. You have low levels of human capital. That you need also to increase the educational standards. The labor market is way too rigid. The costs of hiring and firing in Brazil are quite high. We have an office in São Paulo with close to 400 people, so kind of we know what we're talking about. So that's kind of the agenda. I don't want to be too depressive. Nothing lasts forever. I will suggest, Adam, that the next time, we distribute some Prozac with the meal, and so that we don't get, too depressed with the piece. Things will change. Nothing lasts forever. There is no crisis that never ended. Even the Great Depression ended. Brazil will sort these things out, and if they don't, and there is the possibility that they don't by proactive policy making, the market will sort it out for them, and it will be through the exchange rate. There will be then a very significant overshooting of the currency, capital outflows, loss of investment grade. And that changes the nature of the scenario we are discussing today. This started as a macroeconomic adjustment, mutated into a difficult macroeconomic adjustment, mutated into difficult and perhaps long macroeconomic adjustment that will contaminate the outlook for next year, for 2016, basically 3 years of recession. And the market is now kind of sitting on the fence where this could mutate once more, and we no longer have a difficult macroeconomic adjustment. We have a macroeconomic crisis, which is, again, the capital outflows and the currency overshoot. I don't want to, again, there's so much things to talk about Brazil, but we'll leave it for some other opportunity, and we'll be eager to take your questions.
Thank you very much, Alberto. I regret that we are not licensed to provide Prozac in our buffet, but you are welcome to at least eat dessert and, like the Brazilian economy, have a brief sugar high before crashing back down. Joking aside, that was a real tour de force taking us through so much. But as you yourself said, there is this issue of the closedness of Brazil, and we're going to turn to Jeff Schott to take us through that aspect of Brazil's longer-term difficulties. Jeff.
Well, thank you, and thank you to Alberto. He brought back such wonderful memories of the first time I came to Brazil, and all the talk was of the similar problems and inadequate domestic savings, infrastructure problems, and the like. That was 1978, so perhaps I should title my talk "Back to the Future." But I'm not going to dwell on the future too much, but to say that 36 years ago, there was a brief uptick. Brazil concluded a trade deal with the United States. It was actually negotiated by Fred Bergston with help from Gary Huffbauer and myself. And that agreement unlocked market access to the U.S., secured the successful conclusion of the Tokyo round of multilateral trade negotiations, and most importantly, restructured Brazilian domestic subsidies and other policies necessary for the stability and growth of the Brazilian economy. You can use trade policy and trade agreements and integration arrangements to support and reinforce, complement domestic reforms. It has been done. It isn't done very often in Brazil. Since then, the track record of Brazilian integration and trade pacts has been checkered. In the early 1990s, Brazil established the Mercosur and contributed to the conclusion of the Uruguay round of multilateral trade negotiations. But in neither case did it commit to changes in Brazilian policies and restrictions that continue to burden Brazilian firms as well as foreign competitors in the Brazilian market. Mercosur aspired to be a customs union, but neither Argentina or Brazil allowed the integration of farm and auto policies and industries. That doesn't mean that there hasn't been a lot of trade, particularly in the auto sector, but there has also been a lot of subsidies, a lot of tariffs blocking inter-Mercosur trade, and a lot of anti-dumping and countervailing duty cases attacking each other's markets. After an early boost in interregional trade among the four original signatories of the Mercosur, interregional exports as a share of total trade declined sharply, starting in the late 1990s, and then it flattened out over the past decade, and it's now around 15%. That's relatively low for an integration arrangement that it is attempting to restructure production and trade along regional lines. That just hasn't happened in the Mercosur, and the efficiencies and productivity boost that comes from that has not accrued to the Mercosur partners. The Uruguay round gave Brazilian manufacturing exports new opportunities in foreign markets, especially in the United States and in Europe, but it did little to discipline foreign farm subsidies or require reform of Brazilian protectionism. Nonetheless, trade grew, fueled by the commodity boom, and later so did foreign direct investment in Brazil, encouraged by enticing and exaggerated prospects in the oil sector and sweetheart tax and subsidy deals for foreign investors. Perhaps even some auto companies benefited from some of those deals. According to World Bank statistics, Brazil's trade to GDP ratio, the openness ratio that Alberto was talking about, almost doubled from 15.6% in 1996 to almost 30% in 2004. So it looked like Brazil was beginning to integrate, to take advantage, but of course a lot of that masked the inflated prices of commodities, which was boosting Brazilian exports. But since then, the trade to GDP ratio has declined to about 26%, certainly progress since the 1990s, but lower than any other major economy, including the United States and Japan. I didn't check the numbers for East Timor, but the openness ratio for Korea is about 96%. This is trade in goods and services as a percentage of GDP. Mexico is about 66%. China's in the low 40s. So you can see Brazil is really at the bottom of the list of major economies. It's the largest economy in Latin America, but it has a relatively small footprint in world markets. Its merchandise trade is around $500 billion a year. That was in 2013. It put it among the 16th largest traders among WTO countries. Now, as has been said before, the infamous Brazil cost still impedes the competitiveness of local industry because of high production and distribution costs associated with inadequate infrastructure, excessive regulation, and misdirected tax and expenditure policies. You can look at the World Bank's doing business reports that show the difficulties that firms have in dealing with customs, getting goods in and out of the country, much higher and much more expensive than in many other countries in Latin America, much less an average in the OECD area. The needed reforms are never easy, but certainly easier in a booming economy, and so even more so the lost opportunity to take advantage during the commodity boom to institute the types of reforms necessary to really get the Brazilian economy on the right track. Now it's much harder with weak demand and political uncertainties that have driven investors, many investors, to the sidelines in Brazil. The primary focus of Brazilian trade strategy had been on the WTO and on Mercosur. It later was coupled with odd linkages with the other BRICS. All of these initiatives have failed. I mean, for a country that has such a distinguished foreign service, such smart people in its diplomatic corps, to have such an unmitigated disaster in policy is really stunning. The Mercosur has become an ersatz customs union and a big drag on Brazil's trade. Import substitution policies revive at the slightest whiff of foreign competition and economic difficulty. As an economic union, it is now dysfunctional. And indeed, political objectives have priority over commercial objectives. So there's no real economic gain from Mercosur. It's mostly a major drag. The WTO and Doha, the Doha round provided a great opportunity to blend domestic reform with new access to foreign markets, as in the Tokyo round. But the possible Doha deal in 2008 failed and can no longer be revived. Since then, Brazil has stayed out of all of the plurilateral agreements, initiatives that could spur needed reforms in services, in information technology sectors, and boost prospects for renewed WTO negotiations. They're still on the sidelines. The WTO could still help if Brasilia listened to the Brazilian head of the WTO instead of Brazilian ministers and trade diplomats. They're not doing that, and it's a shame because Roberto Azevedo has got a very clear message, one that's quite consistent with a report on saving the WTO talks that Gary Huffbauer and I and a few of our colleagues put together earlier this year, but it is not being listened to in Geneva. Brazil's strategy with both the U.S. and the EU also has failed. The free trade area of the Americas died a slow death a decade ago, largely due to U.S.-Brazil differences, and we couldn't come together on that. EU-Mercosur talks still exist, but have yielded little and are unlikely to change given Mercosur's situation. The EU has graduated Brazil from its GSP program, so there's actually even less access for Brazilian manufactured exports to Europe than a decade ago. There's also been a failed BRICS strategy that was seen as, well, forget about US and Europe. The real growth centers are now India and China and Russia and South Africa. Doesn't look like such a great strategy today. And indeed, it yielded no real leverage and left Brazil out of the action in the Asia-Pacific region. China is now one of Brazil's leading trading partners, but Chinese demand for commodities is going forward will be tempered, while Chinese competition in manufacturers in both Brazil and in Brazilian export markets will become more intense. That is the sad part of the commodity boom that sold a lot of goods to China that allowed China time to develop its industries to compete against Brazilian manufacturing. There is now no easy solution, and most of the effort to bolster Brazilian competitiveness and growth will require domestic reform. That's what previous speakers focused on, and correctly so. That's where the priority needs to be. Trade policy, though, can help, but it will require a sharp reorientation of Brazilian trade policy priorities. I don't have a lot of time to go into all of these, but I can give you a summary of what needs to be done. The first thing Brazil has to do is start getting real in terms of its international strategies towards integration and trade, PACs. It needs to join the negotiations on the Trade and International Services Agreement, the Information Technology Agreement that was just concluded, and the ongoing work on an Environmental Goods Agreement. All of these would provide great opportunities for Brazil and also complement and provide support for needed economic reforms within Brazil. Brazil also needs to work with the United States, the European Union, and China in the G20 and in the WTO to propel new multilateral trade talks. And here, what Roberto Azevedo is saying, as I mentioned before, is really aligned. He should be representing a strategy that helps Brazil. I think he knows it would help Brazil, but he can't convince his colleagues to do it. And finally, there needs to be a review of what is going on in the Mercosur. There needs to be some restructuring of the Mercosur to allow new linkages with the Pacific Alliance. There needs to be thought of linkages in the future going forward with the Trans-Pacific Partnership and with the Transatlantic Trade and Investment Partnership. Those are ways to revive initiatives with the major markets of Brazil, but will require adoption of significant reforms to meet the obligations of these comprehensive agreements. That might be easier than trying to revive a big multilateral initiative where a lot of countries have different priorities. The requirements of the TPP will become known, hopefully, in the next few months, and that should give Brazil a few years' time to begin to prepare to see what the opportunities would be opened with participation in the TPP, what the challenges will be in meeting the obligations so required. I think that's something worth looking into, and probably something, Adam, that we should look into in terms of our own studies going forward in the years to come. Thank you very much.
Thank you very much, Jeff. Always glad when Jeff is making more work for himself, so that's good. If I could ask Monica, Alberto, and Jeff to take the seats here on the panel, we can open it up for discussion. I won't take any time away from the audience discussion except to just note that when we're talking about the WTO in Brazil, that WTO Director General Azevedo will be coming here to give a major luncheon speech at the Peterson Institute on Wednesday, September 23rd, and longtime Brazil liberalizer Gary Huffbauer will be chairing that meeting, and I hope you'll join us on that occasion. So, for all of you who are unfamiliar or don't remember, we have open discussions here at the Peterson Institute, and I ask that you stand or wave your hand and be recognized. Either Jessica will bring you a roving mic up front, or you're welcome to go to the standing mic at the back of the room. Please identify yourself. You're welcome to make a comment or question, but please try to keep it short so as to allow our speakers to participate. Over there, please.
Hi, Marcus Noland. I am the Executive Vice President and Director of Studies here at Peterson. Monica, I know next to nothing about Brazil, but I do know something about other emerging markets with public sector development banks that lend at subsidized rates. And if you look at the borrowers from those development banks, you also see large, well-funded firms. However, I would offer an alternative explanation to the one that you mentioned, which is that they're very good borrowers. It's because they have deep pockets. If you are lending at subsidized rates, you are creating excess demand for loans. That excess demand has to be allocated somehow, and the universal way that that allocation is done is through bribery, where the borrower, subject to a risk premium, this being associated with law enforcement, will be willing to bribe the decision maker up until the point where those rents are exhausted. So given the size of this market and given the gaps that you showed between the subsidized rate and the market rate, I would have thought corruption would have been absolutely central to this story, but I really didn't hear much about it. So would you like to comment?
Thank you for that question. It's a very good one and a very tough one to handle. Certainly, corruption does have something to do with it. And there are some studies out there looking into, these are micro data level studies, so firm level data studies that look into, the firms that BNDES has actually lent to, what kind of linkages to politicians and to political parties do these firms have? And there is evidence out there that to a large extent, I showed the chart where Petrobras is one of the largest recipients of BNDES loans. So there you go on the corruption story. So there is that evidence, and certainly that has a big part to play, which is not to say that, if you rethink the role of BNDES and you start to, which is I think where Brazil should be going, because BNDES, after all, is an institution that was created in 1952 with the specific purpose of resolving the many development issues that a country like Brazil faces. And it's not an institution that is going to be extinct. It's just not going to happen. So what needs to be done is really a thorough rethinking of the role of the institution. And this kind of discussion is actually, believe it or not, starting to gain traction in Brazil. So there have been calls for greater transparency, for example, in BNDES data. And BNDES, about 3 months ago, came out with a transparency portal. So they now have a website where they make some information available. Some. It's not fully transparent yet, but at least it seems to be moving in the right direction. But I take your point, and it is a large part of the story of that wedge that was in that chart also.
Thank you. The lady at the back mic.
Hi, Anna Wong from U.S. Treasury. So I would like to ask Monica to respond to some of the puzzles I have from looking at Brazil's economy. So if you calculate the output gap just by an HP filter for Brazil's GDP, you started noticing a falling output gap, even dipping into the negative territory in late 2012. So it seems like the slowdown happened a couple of years earlier, but if you look at, if you ask people 2 years ago, most people would not say that Brazil is entering a deep recession, because some people would argue that the unemployment rate was really low. It was like 4 or 5%, if I remember correctly. But then if you look at the labor participation rate, you see that they actually have a similar problem as U.S. unemployment rate, which is that labor participation rate has been falling quite sharply since a couple of years ago. And at the same time, the unemployment rate was falling. So my question for you, Monica, is how do you interpret the unemployment rate, and why is it that the labor participation rate has been falling? And also, in U.S., the labor participation rate fell because it happened at the same time as a deep recession. But in Brazil's case, a couple of years ago, it was still growing quite rapidly. So why was the labor participation rate falling? And what would be the implication on this recession that we are expecting that Brazil will?
And I just asked Alberto may also want to comment on this issue as well as Monica.
Right. And one more question, and maybe.
Anna, we love you, but come on. Let them have a chance to respond, please.
Well, thank you very much for those questions, Anna. They're they're key questions. The question on the labor participation rate is certainly a very important one. The drop in labor market participation happened in 2012 and 2013, and it happened very fast. People have not been able to explain that to any degree of satisfaction, so there really isn't an explanation for why that happened. There are some people who seem to believe that, the social programs that were put in place by the government allowed a number of people to go back to school and to earn degrees. That's the nice explanation. It doesn't really match up with the productivity kind of indicators that you get for Brazil, so I'm not sure I buy completely into that story. I think another story is, the outside option that people had was just better than being in the labor market. So perhaps people have gone back into informality. And this is just to say that labor market indicators in Brazil are very poor still. So it's very, very hard to grasp from the data, for instance, whether there has been transition into informality or not. This is not easy to see in the data, but that's what I suspect happened. Just to make a point on this, recently, what has been happening is that people have been coming back into the labor force. So if the outside option story is true, people just had better prospects outside of the formal labor markets. Well, since the country's been in recession, that has now changed. So a lot of people are coming back into the labor force. And this is actually one of the reasons why you see labor market indicators weakening, and they are weakening. Unemployment numbers are starting to go up quite dramatically. There was a big jump in July in unemployment numbers. So I think these lags that we've seen and the ones that you kind of referred to, 2012, we were already in the beginnings of a slowdown, but labor markets were doing exceptionally well. Now we're in the throes of a recession and the labor markets are starting to react. These are kinds of the normal lags that you would see in Brazil, given the rigidity of labor markets, but there is a question mark out there as to what has exactly happened to labor market participation. I hope to have answered it somewhat.
So just to add something, the labor market is by nature a lagging indicator of the cycle, so it's not altogether very surprising that you see the economy decelerating first and the labor market deteriorating afterwards. This is an issue we have researched quite substantially and deeply. Part of that is a very significant destruction of the supply frontier of the economy, so potential GDP decline very, very significantly due to significant intervention of the public sector in the economy, the price distortions that were created by public policy. So overall, that the HP, backstacking, all those types of filters do not capture well when you have structural breaks at the margin. If you calculate the Phillips curve with the output cap, it has a much, much better fit to actual inflation, because otherwise you don't have enough output cap to explain, the very significant acceleration of the inflation. If you do that fitting with the labor market cap, what is the natural, the Nairo of the labor market, you have a much better explanation. What justifies that, the decline in participation rate? I think it's a little bit of every factor that was already mentioned. One is, rising household income. If, your father has a good job and your mother as well, you can go back to school. And there is actually a significant range that was actually doing neither. There was neither working nor studying, just hanging out. They could afford it. The household income rose quite significantly, so there was no pressing need for the youngster to join the labor force immediately. So you could go to school or just, do something else. The social programs, the cash transfers also complemented and supplemented household income, which allowed that type of behavior. And the third one is labor hoarding. If you go back to what was the outlook for the Brazilian economy starting in 2011. Also, let's start with a somewhat upbeat outlook for the economy. The economy is going to go 2.5%, 3%. Halfway you get to May, June, or maybe not. It's going to be much lower than that. So when you do your business planning at the beginning of the year, you have a certain anticipation of what demand will be, but given the very significant cost of training and hiring and firing, you keep your labor force until it's pretty clear that this is going to be a long-lasting, period of sluggish growth. After 3 years of that planning mistake, let's call it that way, and given that the outlook is pretty poor for the next over the next over the next few years. It's not surprising that you see also the labor market deteriorating now. Also, there was a little bit of moral suasion in certain sectors by the public sector to keep employment levels, particularly in the auto sector, through subsidies and other types of interventions that prevented a more significant adjustment of the labor market.
Thank you. I'm going to gather two questions over here, but just one more point to Anna Wong's very reasonable contrast of Brazil and U.S. We have to be a little more fair on the U.S. side, which is even though the number of us, myself included, came out and said it seemed a little coincidental to have the biggest drop in participation be coincident with the recession. The fact was William Washer and his colleagues at the Federal Reserve Board had predicted well in advance a significant demographic-driven decline in participation. And I have to admit, I came out a year ago and said I was expecting that to not turn out to be the case, that we would see a lot of people coming into the labor force in the U.S. as the recovery continued. The fact is, participation rate's been very stubborn despite a year of expansion. So not to disagree with Anna's important contrast, but just to say we should be a little more fair to and open to the demographic explanation in the U.S. as well, in my opinion. We've got two people here. I could ask to get both your questions so that our people can respond in the room.
Thank you, Dave Nelson with GE. Thank you very much for the great presentations. And I think that most people would agree that your policy recommendations make a lot of sense. I mean, reduce the role of subsidies in credit markets, reduce the deficit, the fiscal deficit, liberalize trade. These are all very good ideas. My question is on the timing. Brazil's entering a deep recession right now, or at least a significant recession, -2%, something like that this year, likely to be in recession still next year. We've seen the debate in Europe around the timing of fiscal adjustment. How does the fiscal the fiscal adjustment is clearly pro-cyclical in a way that's harmful now? How does that play out? Reducing the credit subsidies, Monica, you indicated that there would actually be a fiscal savings on that, but is that immediate? Does that take effect immediately? Because you are having an immediate real impact on the firms that rely on that in a negative way, right? So how does that play out? And on the trade liberalization, I think it's more of a political question. Can you liberalize trade in the context of a recession?
Sunil Sharma from the IMF Research Department. One thing strikes me about Brazil, and it strikes me about India too, is that in these countries we've had an infrastructure deficit. I can sort of remember talking about this when I was in graduate school, and that was a long time ago. Now the question is that we've had these public development banks, and they haven't really contributed to the logistics infrastructure either in Brazil or in India. And we've been talking about a variety of ways of making sure that the infrastructure is actually built. Airports, I mean, just talking about the transport infrastructure, not broadly speaking in terms of water, health, education, which is required. The question is, how do we generate the political momentum or other ways of providing the physical infrastructure? I mean, when you look at China's fantastic development over the last 15 years, a very large proportion of it has to do with the fact that they went out and actually put in place a physical infrastructure, which utilized, in some sense, externalities created for the private sector, or the so-called private sector in China, were huge. The question is, how do we do that? We haven't been able to do that for the last 40 years in India. We've been trying to integrate with the services sector around the world, and if you go to Bangalore and you talk to the firms, many of them have been actually developing their own private infrastructure, whether it's shipping stuff to the airport, shipping workers to the firms, and so on and so forth. How do we do this in Brazil? How do we do this, mobilize the banks to get done, public sector banks?
Thank you both for very substantive questions. I'm going to suggest that we go Jeffrey, Alberto, Monica, and each of you can respond to whatever piece of those rich questions you wish.
Thanks. I'll be very brief. In terms of the sequencing of trade liberalization, there isn't much that would be done today, tomorrow, or next year in any of the initiatives that I talked about. Indeed, the trade agreement that really requires immediate implementation is the trade facilitation agreement reached in the WTO, which is really much more about removing some of the customs red tape, dealing with some of the port infrastructure constraints that should be part of the broader domestic restructuring. In terms of the other agreements, if Brazil started to participate in those agreements, it would really facilitate and perhaps propel agreement in the coming years for hopefully implementation once Brazil is on the upswing. And indeed, the expectation of an agreement coming through in which Brazil would be a party could lead to some positive announcement effects in terms of investment.
Just on the question of fiscal consolidation, timing, or sequencing, definitely most of the problems on the fiscal side are structural. It's going to take a while to sort them out. But I think what has disappointed the market the most over the last few months, and Monica had one slide showing the significant revision of the outlook for the primary surplus for next year, started with an original target of 2% of GDP, was revised to 0.7, and now we're talking about minus 0.5. And I think what unnerved the market the most is in that revision, there was no intertemporal trade-off. I think everybody could accept that cyclically adjusted, the fiscal is what it is. Revenues are declining. We have a deep recession that is undermining the revenue collection capacity of the public sector. But there is absolutely nothing so far that presents you a medium-term vision, a medium-term strategy to contain the drift of mandatory spending. I think the market would accept the minus 0.5, the zero minus. That's not the key issue. The market would easily finance the budget overrun in the short term if we were to see significant bills or like a serious social security reform and many other bills delinking the minimum wage from past inflation and other measures that you could see that the fiscal outlook was improving. You could see we have this reform that produces zero dividend in the short term, but in NPV terms, adds, subtracts 20 or 30 percentage points of GDP over 20 years. That's what is needed in order to validate, the reality that we have today. What is not acceptable is that you revise today, you revise next year, you revise 2017 and 18. And that's exactly what happened, and that's what is behind the very negative market reaction to the latest announcements. On infrastructure, which is, kind of, a long-standing issue. What needs to be done, I think it's twofold. One is the direct responsibility of the public sector in terms of providing enough public goods, public infrastructure, with the direct responsibility, in part, at least in part, of the public sector. It's not for lack of resources. The tax burden is very high. Spending is even higher, and investing, taxes too much, spends too much, invests too little. So diverting resources within the budget more into capital spending rather than current and productive spending, it's key, and that that links with a medium-term structural reform. Even if you spend the same amount, at least can we make sure that we invest more and we spend less resources in current spending? And second one is to basically to co-opt the private sector into that effort. And there have been several unsuccessful attempts into engaging the private sector in airports, ports, roads, and many other infrastructure projects, but there's still too much intervention. The regulatory framework is punitive, is uncertain, it's not necessarily very market friendly. This is a government that was still trying to have too much control over those investments, and I think the oil sector is the ultimate example of that. So we need, a little bit like hands off in a way, right? If you want, you cannot determine all the variables, how much they invest, what is the internal rate of return, and a bunch of other things. So kind of lighter regulation in those sectors, and a bigger effort within the envelope of fiscal resources to direct more into infrastructure, could start to move the needle. But the deficit in infrastructure is quite significant.
I'm just going to complement 2 points because I broadly agree with what Alberto has said, both on the infrastructure issues as well as on the pro-cyclical fiscal / public bank lending issue. And it's how I ended my presentation. The problem is the lack of a constructive agenda. It's not per se the kinds of policies that are being done now and the kinds of restrictions that are currently in place, but more about so what is actually going to be done in the medium term. And in about 9 months ago, when the finance minister accepted his new position, he laid out a medium-term strategy. And it was very clear what was going to be done on the public lending side, on the fiscal consolidation side. And that agenda is now gone. So I think this is the first step. We need to recover that agenda. And I broadly agree with Alberto on the points that he's made about, what the markets would be willing to basically to put up with, let's put it that way, in order to have that kind of agenda. So that's really what we're talking about. In terms of the infrastructure issues and the comparison between Brazil and India, which I always find fascinating because I think there are so many things where Brazil and India can, be test cases for each other. I think the big question here is to look at, and this is something that hasn't really been done to a large extent, but should be, which is, kind of evaluate what other public banks have done around the world, and I think this is one of the initiatives we have here at the Institute. What have development banks in other places done in infrastructure? What have their strategies been? What works and what doesn't work? I think we need to answer those questions in order to be able to really address the kind of question that you put forward. Because in the case of Brazil, BNDES has been largely responsible for infrastructure investments, and yet it's fallen short in many respects. Why is that? I think Alberto touched on what I consider to be the main point. There hasn't really been any strategy to bring in the private sector together with BNDES. So you need a strategy like, for example, Colombia currently has with its Financiera de Desarrollo Nacional, which is a development bank that was set up specifically for infrastructure. And what they do is that they finance projects together with the private sector, trying to resolve the kind of market failures that exist when you're trying to finance these types of projects in a market-friendly way, not in a way that crowds out the private sector because there's a lot of subsidized, untransparent, opaque lending going on.
Terrific. This is Monica's first public appearance as an Institute Fellow, and I not only am thrilled with the content, which of course is what is most important, but I'm delighted that she's already picked up, as Jeff amply demonstrated, that it's always about telling you what else we're doing and what we're doing next. And just to repeat the advertisement, we are having a joint conference with our friends at Moody's and CG, Center for International Governance Innovation, in this very room on September 30th, talking about the multilateral development banks in particular, but also the AIIB and the Silk Road Infrastructure Initiative in Asia. Monica, along with numerous other members of our team, are going to be Simon Johnson and Simeon Jankov will be speaking for us at that event. But other members of our team are going to be continuing to develop work, and we plan to be doing some work on China as a global infrastructure investor, taking lessons, as Monica suggested, from around the world, some of the work Mark Nolan, for example, has done in the past, and bringing that forward by this spring. Let me, however, focus on the here and the now. I think this was a terrific event. I'm very grateful to all of you for joining us and all of you for your highly sophisticated questions. I'd like to thank Jeff for giving us the long and the short-term perspective on trade, Alberto for covering a huge amount of ground with very blunt, practical assessments, which is always wonderful to hear, and Monica for bringing us the combination of the topical matters with her longer-term research. This meeting is adjourned.